Hey everybody, welcome to your weekend review for the week of Monday, October 3rd, 2022. And oh, what a week it was. All hail and behold, an elusive win on the bond market. MBS opened up the day being up 85 basis points real early. Stocks were even up 33 points. Everything came in because the UK changed up its plans and they are not going to do their massive amount of stimulus that would have caused a ton more inflation, all while they're trying to raise their interest rates, which really doesn't work that well in conjunction with each other, and everybody knew it. It tanked our bond market last week, and they decided they're not going to do that. More than half of the sell-off has now been retracted, with the US 10 starting the day trading just under 3.71, which is a technical level, which is down 15 basis points. There was a closed-door meeting by the Fed today. Haven't heard the announcement about it yet, but a lot of eyes are predicting that it is about the possible failure of Credit Suisse and its implications on the mortgage and bond market in America. Credit Suisse is a huge bank that has invested heavily in mortgages over the years, and everybody's kind of worried that it is another Lehman Brothers or Bear Stearns moment. We'll have to see the news that comes out from that. We also got ISM manufacturing, which came in at 50.9, which is a little under estimates and a little under the previous. Prices paid were about the same, down 0.2%. ISM employment was down quite a bit, coming from 54 previously down to 48.7, and new orders were down quite a bit from 51.3 to 47.1. Not great for the manufacturing sector, though hopefully it will help with the inflation numbers, though it does factor in also with what we're going to see for our non-farm payroll numbers later on this week. Residential construction fell 1% month over month, but is up 12% year over year. More institutional investors are thinking the worst of the bond market is behind us. Here's hoping. One of the big things to watch for this week is Wednesday. OPEC is meeting to discuss oil production. Most signs are there will be a cut in production, likely to push oil back over $100 a barrel, which will make inflation much worse and make people more depressed and post things about it on Facebook. Fed Vice Chair Leo Brenner over the weekend made comments actually acknowledging the possibility, we'll go with the word possibility, that the actions of the Fed to quell inflation could have other negative consequences, which opened the door in some people's minds and maybe next time they'll do a 0.5 rate hike instead of 0.75. But subsequently, a lot of other speakers from the Fed came out and said, we're going to do whatever we got to do to get rid of this damn inflation. So don't hold your breath on that. All in all, at the end of the day, we ended up being up 95 basis points on the 5% UMBS, and the Treasury was down 16 basis points, which is quite a bit, down to 3.64. We are at the top end of this range with a ceiling of 98.649 and a floor of 97.02. Hopefully we can make a run for that and get through that resistance tomorrow and keep things in the positive direction for the bond market. Mortgage bond performance in September was historic, albeit in the bad sense. The U.S. MBS excess return versus Treasuries came in at minus 1.91%. It's the worst monthly performance in the history of the index. This is basically saying that there's been a fundamental disconnection in how the 10-year Treasury trades versus the mortgage-backed securities. This is largely based off of the prediction that we're going into a recession next year, which will cause rates to go down. The MBSs will refinance, therefore returning the money when they have to reinvest it at a lower rate of interest. So people would rather have the Treasury. Also saw this today that median housing costs for renters rose more than owners. So now the median renter now pays nearly the same as the median homeowner. So there really is no advantage to renting because you're both basically paying the same and you don't have any upside of appreciation. On Tuesday, we had our second positive open in a row that has us feeling absolutely luxurious. When we got up on the West Coast, MBS were up 25 basis points early, and stocks were up 100 points as well. Bonds were sideways to slightly weaker in the overnight session, but rallied after Australia's central bank hiked rates by less than expected. Everything stayed right around those levels pretty much all day, with the MBS 5% ending the day up 20 basis points and the S&P index up 112 basis points. So we actually got a win on both stocks and bonds. which is awesome. The 10-year ended up being down 2 basis points on the yield, which is kind of helping narrow the gap between the treasuries and the MBSs. The big news on the day was that the United Nations had called on the Fed and other central banks to halt rate increases. This is over a fear of a global recession that will disproportionately impact vulnerable nations. With our 6-month risk-free treasury paying 4%, many foreign investors are only buying that debt. This is converting all of their currency into dollar and making the dollar stronger, which is tough for these smaller countries to trade with each other. Job openings declined in August. According to the JOLTS report, the quit rate was flat at 2.7%. This report is further evidence that the labor market is softening. Now, don't mistake that for a soft labor market. It's just softening. The labor market is still quite strong by historical standards. They're just not out of control as they were before. Markets are digesting yesterday's ISM data that showed that supply pressures might be easing and prices paid are going down a little bit. This could help our inflation report, although we do have an OPEC meeting coming on Wednesday that will probably make things much worse on inflation. We also got comments from Fed members feeling that the hikes are starting to work. This has some people feeling like the next hikes could only be 0.5%. Though that's a bit premature in my own personal opinion. Home prices dropped by 0.98% in August, according to Black Knight's Mortgage Monitor report. This is higher than the 0.6% decrease that showed up on the FHFA price index. Atlanta's Fed GDP Now index now sees Q3 GDP coming in at a positive 2.3%. which is a pretty radical increase from being a negative number in the second quarter. They're citing personal incomes and outlays report from last week to drive the increase. Seems pretty high to me. Tomorrow we get the ADP report, which is expecting 200K new jobs, and also that OPEC meeting, which has a chance to really shock things tomorrow. We also got news this morning that PennyMac has reversed course and lowered their conforming limit for the new year from 715,000 down to 700,000 as home prices begin to soften. They aren't as confident that the FHFA is going to increase it as much as they thought before. This is going to put a shock into some lenders' pipelines. We also got a new post from our sponsor at WellThatMakesSense.com. It's all from the Innovator's Dilemma. What should managers do when faced with disruptive technologies that customers do not want right now? First instinct to say is, if customers do not want it, why would you even pay attention to it? But the key on this is it's stuff that they don't know that they want right now. Reference the old quote from Henry Ford where he said, if I would have asked my customers what they want, they would have said faster horses. Customers don't know what they want until they know what is possible, and that's how disruptive technology can turn your business upside down before you realize it. So check out the post from Innovator's Dilemma on www.wellthatmakessense.com. And then Wednesday confirmed what many feared, that the gains on Monday and Tuesday weren't actually fundamentally market-driven. It was more a whipsaw effect of reaction to bad policies in the UK and then the reversal of bad policies in the UK. So early on Wednesday, UMBS 5.0 were off 62 basis points real early in the morning before getting worse and then a little bit less worse. Also on Tuesday, the Labor Department reported that 1 million fewer job openings than expected in August, which is a sign of a potential narrowing of the job market. This is the second sharpest decline on record. High demand for workers has also pushed salaries higher, which has accounted for rising inflation. ADP job report came in at being up 208,000 jobs, plus a positive revision to last month. This is on a projection of 100,000 even. So it is a win, not a huge win for the jobs. However, it shows some moderation in the labor market. ADP data reinforced what is still a strong job market, which is implying that the Fed can do more hikes. All of the gains are in the service producing sectors. They were up 237,000 jobs, while good producing sector was down 29,000 jobs. Last month was revised higher from 132,000 to 185,000. Annual pay for job stayers was up 7.8%, while job changers saw a 15.7% rise. And not that the Federal Reserve watches public opinion, But there's nothing to say they don't, because a Harris poll found that half of Americans want the Federal Reserve to bring inflation under control quickly, even if it leads to recession. About 2/3 of those responding to the poll said that they were concerned that companies may start scaling back after hiring or begin laying off current workers. Apparently, OPEC doesn't like us much. They are cutting oil production by 2 million barrels a day. This will significantly hurt inflation and help Russia in its war against Ukraine. Great. We also got ISM PMI data, which is a lot of initials, but basically Purchasing Managers Index came in at 56.7 on a forecast of 56. Business activity was 59.1 when it was 60.9 previous, so pretty close. The Employment Index came in at 53 on an expectation of 50.2. This is the highest since March. Yet more data that the employment is staying strong, giving more ammo to the Fed to raise those interest rates a whole bunch more. While results are mostly modestly stronger than expected, but not insanely robust in the big picture of things, nonetheless bad news for bonds. As we said, bonds were down 738 on the open, went down 72 before retreating. Less bad is more good, I guess. Ending the day down 45 basis points on the day. Also, the mortgage sector eyes were set up popping by a plunge in the MBA's refinance index on Wednesday to its lowest in over 2 decades, and even more so by the sheer size of the drop. The latter was a surprise, as the index was already very low to begin with, and then the week-over-week drop was 17.8%, was the largest in percentage terms in the last, or at least in the top 50 for this millennium. So that's 1,188 weeks. Also, due to heavy financial losses and streaking production, Loan Depot has reduced its funding capacity. So they've given up $1 billion worth of warehouse line capacity, laid off thousands of workers, and exited the wholesale lending business. However, it hasn't stopped them from issuing generous pay raises to a lot of its top executives. People have thoughts on that. After a couple of good days early in the week, Thursday, we are down again. We're down 59 basis points really early. OPEC is cutting production, which will drive the oil prices up and make the Fed's job harder. Some strategists are forecasting the triple-digit oil prices as the cuts begin to bite. Supposedly, the administration is looking at releasing reserves from the Strategic Petroleum Reserve. However, it's not very large. Our strategic oil reserve is 416 million barrels, which is actually the lowest since 1984. Home prices rose 4.2% quarter over quarter, which is 14.8% year over year, according to the Clear Capital Home Data Index. The index is about a month ahead of other home indexes like Case-Shiller and FHFA. Interestingly, we're seeing the biggest quarterly growth in the Midwest and the Northeast, which were laggards over the last couple of years. We also got initial jobless claims, which came in higher than expected, 219,000 on a forecast of 203,000, higher than the last reading at 190,000. Continuing claims are real strong at 1.36 million. That was the only real economic release on Thursday. However, several Fed presidents spoke and reaffirmed they're going to do whatever they got to do to stifle inflation. U.S.-based employers announced almost 30,000 job cuts in September, which is up 68% compared to a year ago. Hiring plans are also at the lowest since 2011. Apartment vacancy rates remain at multi-decade lows. However, we continue to see deceleration in rental inflation. So rental prices are still going up, just not as fast as they were, given that rental inflation tends to lag housing inflation by about 21 months. I suspect we might see a re-acceleration in rent prices, especially since home building is also depressed. Like we said earlier, the day we were down 59 basis points early, on the day we ended up being down 64 basis points. And we're right in the middle of that big range between, with a ceiling of 98.297 and a floor of 97.02. We also got another post from our sponsor at WellThatMakesSense.com. 3 classes of factors impact an organization, what they can and cannot do. This is people, equipment, and technology. Product designs and things like that are the most visible, but there's 3 things that factor how well your organization can innovate. It's good to know these things if you want to be an innovator and not fall behind. On Friday, October 7th, MBS were down 34 basis points early as stocks were falling 77 points at early trading. MBS pretty much stayed around that range, but stocks continued to sell off as the day went along. Economy added 263,000 jobs in September, which was above the street estimate of 250,000 and the ADP estimate of 208,000. The unemployment rate fell to 3.5% and average hourly earnings increased 5%. Everything we're hearing this week, labor market holds strong, and we got to remember that the Federal Reserve has two initiatives: watching prices and making sure inflation doesn't go too low or too high, and making sure we stay fully employed. Number two is firmly doing good, so that gives them more ammo to lean in on number one. The reality is that we're going to see rates hold in the sixes and vomit sevens a while, likely through the end of the year at the earliest. It's tough to worry about a recession when nothing other than the nonsense GDP points to it. Compare the US, Europe, especially England. They are a train wreck. On the other hand, we are not. According to Curinos, September 2022 funded mortgage volume decreased 57% year over year and 9% month over month. That's pretty tough. And retail channel funded volume is down 61%. Curinos sources a strategically significant data set directly from lenders and produce these benchmark figures. Bottom line, nothing is lined up for lower rates in the foreseeable future. So being down 28 basis points on the day, we end the week at 97.13, which is barely above that floor of 97.02. If there was any decent liquidity in these higher coupons like 5.5, we'd probably be looking at those, but all the money's still going into the 5. From Hammer Helmer over at Originator Success echoed what I've been thinking and probably just kind of said it a little bit better or said it first. Next week we get CPI data, but come on, do you really think that's going to roll in on a white horse and save the day? No, I don't think so. Here's his thinking, which echoes mine. He just came back from a trip in Vegas. The airports were full of people. The airplanes were full of people. The casinos were full of people. The hotel was so full they were sold out. His point is consumer spending is still up and economic reports are still showing a resilient economy. There is no real reason to expect inflation to have dropped much. We can argue about the whole compared to last year, blah, 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 but I don't see enough core inflation movement month over month to spark the market to say that inflation has gone away. I've been saying this a while privately to a lot of my friends. I've said it on here a couple of times, is I think people are so addicted to buying new things, doing new things, going out to eat, that even in spite of all signs that we are heading into a recession, we're just going to keep spending into the recession, because I think for so many people, buying new shit is the only thing that gives them any kind of a dopamine hit, and they're just going to keep buying stuff because it's one of the very few things that makes them happy. So I feel like the next recession isn't going to be as bad as the last one, but it's sure going to seem like it because people are going to act like it. Next week, we get a lot of data. Very important week. We're closed on Monday for Columbus and Indigenous Peoples Day. We have a roll date. We have a three-year note auction on Tuesday, which could move the market a little bit, but the big days are Wednesday, Thursday, and Friday. On Wednesday, core producer prices. So inflation. We get a 10-year auction right after that, so we'll see the market's reaction to that in real time. Then on Thursday, the big one, the granddaddy of them all, CPI. Getting core CPI, consumer price index. This is inflation at its finest. We also get some jobless claims, so you're going to see how much things have increased in price and how much it's impacted jobs. Like we talked about, the Fed's only two concerns is the job market and the CPI. We also get a 30-year bond auction. So 10-year and 30-year bond auctions in the middle of the week will set the market's reaction to all of this data. And then on Friday, we get retail sales as well as consumer sentiment and one-year inflation outlook. So make sure to have a great long weekend if you're getting one. Have a couple brewskis because we're going to have to button up tight next week. And if you have some extra time and you want to learn some stuff, check out our common sources and influences. Have a great weekend, everybody.